Stock markets are reeling following the U.S. government's decision to impose sweeping tariffs, raising concerns over whether we're witnessing a full-blown market crash and what it might mean for your finances. The term crash isn't used lightly. Historically, it describes a market drop of over 20% in a single day or across a couple of days. Take Black Monday in 1987. U.S. markets lost 23% in one day, and others around the world quickly followed. Or the 1929 Wall Street crash, when the market plunged over 20% in 2 days, and more than 50% in 3 weeks, sparking the Great Depression. By comparison, today's U.S. market is down about 17% from its February peak, and roughly 2% lower than this time last year. That's not quite a crash, but it is the sharpest decline since the pandemic panic of early 2020. A fall of 20% or more from a recent peak defines a bear market, a signal that markets expect more losses than gains in the near term. We're hovering close to that threshold. While some people own stocks directly, most of us are affected through our pensions. There are two main types. Defined benefit pensions promise a fixed income in retirement, regardless of market ups and downs. Defined contribution pensions, the more common type today, depend on how your investments perform, including stocks. That might sound alarming, but not all your pension money is in shares. A significant portion is typically invested in government bonds, especially as you approach retirement. Bonds often rise in value when markets fall, as investors seek safer assets. And that's what's happening now. So, the closer you are to retirement, the more protected you likely are, since your pension is probably more heavily invested in bonds. Importantly, pension investing is a long-term strategy. While markets do fall, they also recover, and historically, stocks have delivered solid long-term growth. The concern goes beyond pensions. A company's share price reflects expectations about its future profits. If markets are falling, it's often because investors believe profits will decline. And tariffs, like those recently announced, are a major factor. By raising the cost of imported goods, prices go up for consumers. Demand goes down. Companies sell less and may cut back on investment and jobs. Corporate profits shrink, and so do share prices. So the bigger warning here isn't just about your portfolio, it's about the health of the global economy. Prolonged declines like this can signal an approaching economic slowdown or even a recession. About the stock market drop, it's sharp but not a crash, and not unusual in the big picture. About your pension? If it's diversified, as most are, you're probably still on solid footing. About the economy? That's the real concern. Tariffs could hurt growth, reduce jobs, and raise prices across the board. This could be a turning point for the global economy, and how governments respond in the coming months will be critical.